Good evening. Today, we embark on a thorough examination of a developing financial story, which bears particular significance for older citizens across the United Kingdom. New information has emerged, indicating that banks and building societies may introduce tighter withdrawal limits on cash withdrawals by customers over the age of 65. This proposed change comes amid a wider government effort to transition towards a more digital economy, while simultaneously pledging to safeguard universal access to cash. This delicate balance between modernizing financial infrastructure and protecting vulnerable customers is at the heart of this discussion. It is important to clarify that no formal legislation has yet been passed restricting cash withdrawals by over 65s specifically. However, anecdotal reports from pensioners and advocacy groups suggest banks may quietly enforce more stringent internal controls. Some institutions now require advance notice for larger branch withdrawals or impose lower daily limits for older customers. While these measures are often justified as protections against fraud, they have sparked concern among over 65 savers who regularly rely on cash for everyday expenses, paying tradespeople, or supporting others in their local community. Government policymakers are keenly aware of this situation. The Treasury and the Financial Conduct Authority have introduced regulatory frameworks, such as the Financial Services and Markets Act, and updated FC rules to ensure banks cannot withdraw access to free cash facilities. The so-called 3-mile rule requires major banks and building societies to ensure customers can withdraw or deposit cash within a 3-mile radius of their home, with enforcement and fines for breaches. While this rule applies universally, no current legislation differentiates between age groups. Yet, the anecdotal focus on over 65s suggests informal age-based policies may be emerging under the guise of fraud prevention. These developments come at a time when Vladimir Reeves's government has introduced new headline-grabbing policy changes affecting older citizens. Spending on winter fuel support is a recent example. Winter fuel payments were initially restricted in 2024 to only those pensioners on means-tested benefits. However, following public backlash and growing concern, the Chancellor reversed the policy and reinstated a universal payment for pensioners earning below £35,000 a year. Over 9 million pensioners will now receive a payment of £200, with those aged over 80 receiving £300, funded through tax clawbacks on higher earners. This signals a simultaneous push by government, both to tighten fiscal controls and to extend protective support for vulnerable groups. The same theme carries over into the broader pension framework. The government reaffirmed its commitment to the state pension's triple lock guarantee, which mandates annual increases by whichever is higher among inflation, wage growth, or 2.5%. With inflation projected to reach 4% in September, the state pension is set to rise by approximately 4.1% next April. This would add around £478 to the average annual pension, raising it to over £12,451. However, this fiscal generosity increases pressure elsewhere. The Office for Budget Responsibility warns that this upward pressure might push some pensioners into income tax territory if personal allowance thresholds remain frozen, potentially by 2027. The Department for Work and Pensions has also recently initiated a landmark review of the state pension age. This review, mandated every 6 years, will evaluate changing demographic trends, life expectancy, and the financial sustainability of current retirement thresholds. Work and Pensions Secretary Liz Kendall reaffirmed that the triple lock remains out of scope for this review, but emphasized the rising state pension age, currently 66 and scheduled to reach 67 by 2026 to 2028, may face further adjustments as part of efforts to maintain long-term viability. Turning to working age benefits, the Chancellor delivered a spring statement on 26 March 2025, outlining major reforms affecting universal credit and disability-related payments. The health component of universal credit will now be limited to claimants aged 22 and over. Younger recipients will no longer qualify. In addition, eligibility criteria for personal independence payments are being reassessed, and 10,000 civil service roles are being eliminated as part of wider cost-cutting measures. Meanwhile, certain penalties for late VAT or self-assessment payments have been increased, reflecting a more stringent fiscal climate. Regarding cost of living support, the much-anticipated so-called cost of living payment series has concluded. After a final installment of £299 in February 2024, no further fixed amount payments are expected in 2025. Instead, the government has shifted to standard annual operating benefits increased by 1.7% for working-age recipients, local housing allowance realignment, and continued investment in the Household Support Fund, worth around £742 million. While there has been speculation around a potential new scheme offering between £301 and £500 across the year, the Department for Work and Pensions has officially confirmed no such scheme is in place at this time. Very recent adjustments affecting benefit schedules are also relevant. Due to the August bank holiday, 11 means-tested benefits including universal credit will be paid early this month. Claimants scheduled to receive payments around 25th August will instead see them issued on the preceding Friday, 22nd August. It is vital for recipients to be aware of these changes to avoid budgeting surprises. In addition, parents receiving child benefit are reminded to inform Revenue and Customs of their teenage children's education plans before August 31st to maintain payment eligibility until age 19. When we consider the cumulative effect of these policy shifts, bank cash access restrictions, winter fuel reinstatement, state pension rises, benefit rule changes, and payment schedule adjustments, it becomes clear that over 65 households are experiencing a period of profound financial change. On one hand, they benefit from increases in pensions and fuel support. On the other, they face growing restrictions on cash liquidity and the spectre of tax exposure as income thresholds remain frozen. For pensioners concerned about potential withdrawal limits, here are clear steps to take. First, engage your bank directly to understand daily or weekly cash withdrawal limits and any policy for advance notice. Second, track local FCA communications to ensure your bank complies with cash access regulations, especially the 3-mile rule. Third, if you encounter a refusal or limitation without clear justification, file a formal complaint and contact your local Citizens Advice Bureau for assistance. Fourth, stay informed about scheduled pension uprates and fuel payments, verifying entitlement based on income thresholds and age. And finally, adjust financial planning in anticipation of possible income tax once pension income exceeds the current personal allowance threshold, roughly £12,570. In conclusion, we are witnessing a dual-pronged policy approach, enhancing financial support for pensioners through higher pensions and fuel payments, while concurrently reinforcing banking regulations that could inadvertently hinder cash access for the same demographic. Policymakers are walking a fine line between digital innovation and protecting vulnerable citizens. To remain secure, over-65 savers must stay vigilant, informed, and proactive. Thank you for joining this comprehensive update. Remain alert to official communications from the Department for Work and Pensions, Revenue and Customs, the Treasury, and your banking institution. We will continue to monitor developments in bank cash access, pension uprates, tax thresholds, benefit reforms, and payment schedules. Your financial independence, dignity, and security remain our paramount concern.